In fact, as we talk about the European markets, here's a view coming in from Sean Darby, Chief Global Equity Strategist. He joins us live through Hong Kong. Sean, hi, morning. Thanks very much for taking time out and joining us on the show today. Firstly, your view on the kind of data points that we are seeing from US, because increasingly it seems that US markets are taking it on the chin on account of the kind of earnings that we are seeing, and what we saw from Google was largely disappointing.
Well, I don't disagree with you. I think two trends about US earnings. One there wasn't any really significant downward revisions apart from the transport sector coming into the season. And secondly, I think that risk appetite is very strong, and certainly the measures that the Fed has taken through QE3 has made it unlikely that you're going to get the significant sell-offs or profit-taking that you would have normally had on some of the results coming through. So it's a little bit odd at the moment because you've got this sort of false market in which results and some of the macro data is a bit weak, but the markets are not necessarily reacting as badly as you would have seen perhaps over previous cycles.
Sean, so are you pleasantly surprised with the ability of global markets to shrug off bad news?
Well, I think to some extent the bad macro news has also come alongside the policymakers, particularly in Europe, trying to get ahead of the problem. And that's probably been one of the reasons why you've seen equity markets rebound, is that there's a confidence factor that the policymakers can turn this round. I think the difficulty is going to be for the equity markets is that 2013 is unlikely to see any growth surprises. If anything, we're still going to be seeing a slew of downward revisions to GDP. And it's unlikely earnings numbers are going to get any better either. So whether you look in the US, Europe or Asia, most of these earnings integers for the equity markets are actually flat to slightly falling. So again, I think it's going to be difficult for equity markets to make big gains from here in 2013 unless there's a really big turnaround in growth expectations.
Sean, what did you make out of the data points coming in from the EU summit on day one, considering there was hardly any talk about Spain or Greece, which one would assume would actually top the agenda?
Well, I think those two issues are being dealt with. One is through the Troika meeting for Greece, and there's, there really the answer to that question has got to be at some point Greek debt has got to be once again written off, both with the ECB or the IMF through some mechanism, because they're still hugely indebted relative to GDP. And secondly, for Spain, it's really a cat and a mouse game there. Whether Rajoy decides to go for the bailout before year end or wait until early next year when Spain needs to roll over around about 200 billion every year from 2013. So I think there wasn't likely to be much of a mission statement or any other announcement from the EU, because most of this now is going on behind the scenes, and it probably wouldn't be for public consumption.
Sean, your India strategist Nilesh Jasani has a rather cautious view on India. So at Jefferies, even though in India reforms have kicked in, why are you still maintaining a cautious outlook on India?
Well, I think it's two things. I think one is the fact that we are seeing perhaps structurally lower expectations on growth, and it's not just in India, but throughout the emerging market universe. Brazil and China are both suffering from this same phenomena. So that's one of the reasons why we've been more cautious. Secondly, the imbalances within India are still very significant. And I guess this comes back to your original question, is that if we had the type of imbalances just as well as the type of disappointments in growth and earnings during any previous cycle, this would have spelt a pretty difficult period for India's equity markets just as much as anybody else's. So the older hands of markets like myself and Nilesh probably have been penalized a little bit in this cycle, given the extent that risk appetite has been driven by the policymakers to such extremes. And that's again reflected in the inflows that has gone into India over the last 2 quarters.
So, Sean, do you think it's just a matter of time and we would again be facing threats of a sovereign downgrade?
Well, I think really the equity markets can remain in this type of sort of suspended animation until we get, as I say, some form of an external shock, or in fact the growth numbers really begin to disappoint. And I think, as I say, that might be the case in early next year, because the fiscal contraction that's going to happen throughout Europe is going to mean a fairly brutal period for GDP downward revisions. And bear in mind, that's also going to be the case in the US with the fiscal cliff as well. So Europe's already in recession. It's technically possible that, you know, the US goes into some form of a slowdown early next year if the fiscal measures are all implemented. So these are pretty difficult times for equity markets, given the fact of the bounce that you've had since June of this year, which in most cases has been of double digits.
So, Sean, I don't want to get this one wrong, but correct me if my interpretation is wrong. Are you sending a message across that this is as good as it gets when it comes to emerging market equities, and especially when it comes to India?
Put it this way, if we were to see an export pickup, lower energy costs, a very benign environment for policymakers in terms of an ability to curtail some of the fiscal tightening, that would be the ideal scenario for emerging markets to continue to advance. So those really are the three prerequisites, because we've already made very good headway on the back of the risk adjustment by the central banks. But it's those other three factors that are going to drive equity markets higher, I think, in the near term.
So, Sean, the ultimate question is, where should traders or where should money managers invest? Because US treasuries are mispriced. Emerging markets, according to you, they're fully priced. US economic data is slightly anemic. And if I look at Europe, Europe currently is in a recession. It soon could be depression.
Well, I don't disagree with any of the comments that you made. And, asset classes or financial asset classes have been so distorted now by QE policies. It's very hard to actually acknowledge what has been discounted. And you've got crude oil prices close to $100, which would normally suggest global growth is pretty good. US, as you pointed, government bonds, was at record lows, despite the fact that most countries' fiscal conditions are actually deteriorating. So I think we've got to sort of step back a little bit and just reflect the fact that equity markets are a discounting mechanism, and presumably these markets now have discounted an awful lot of aggressive policy moves. And that's really my key, that unless the earnings environment or economic numbers start to improve, the chances are these equity markets will have to retreat because purely on the back of the economic data, there's not really they're not really reflecting the fundamentals as one would have expected.